Okay, so income statement. So we just finished with the balance sheet, which is a a snapshot of the firm's position at a single point in time. Income statement is very different. It presents the results of operations during a specific time period, usually 1 year. The financials we're going to look at here, are over a year's time. Summarize the revenues that are generated, the expenses that a firm incurred, the and so this is Unilate's income statements. We have December 2006, December 31st, 2016. Prior years are presented. That's very common to have 2 years, so you have the current year and the prior year. We'll have sales, cost of goods sold, gross profit. So the then we have that EBITDA. We have gross profit, fixed operating costs. We take that from gross profit, and we get EBITDA, or earnings before interest, taxes, and depreciation. We take out depreciation, and we get net operating income, which is also referred to as EBIT, or earnings before interest and taxes. It's probably more commonly referred to as EBIT. Then we take out interest, and that we drop the I, that's earnings before taxes, or EBT. We apply the taxes. In this case, it's 40%. So 90 times 90 million times 0.4 is 36 million, so 40%. So we subtract that out and we get net income. Net income is known as the bottom line. This is the company's profit. At this point, the company has to decide, what are we going to do with our money? Are we going to pay it out to shareholders, which is common dividends, or are we going to reinvest it in the firms, add it to retained earnings? So one of the big decisions that a firm has to make. So from the income statement, we can calculate earnings per share with net income and the number of shares outstanding, dividends per share, or common dividends divided by a number of shares outstanding. Next financial statement is statement of cash flows. Reflects or reports the effective firm's activities on its cash position. So how have our operations, our investments, our financing, how have they affected our cash position? So they examines investment decisions and financing decisions, so uses of cash and sources of cash. So if we look at the statement of cash flows with regard to sources of cash, so if we increase the liability account, in other words, we borrow more, that's going to increase our cash position. If we increase our equity account, in other words, we issue stock, that's going to increase our cash position. On the other hand, if we sell inventory, selling inventory is going to increase our cash position, so reducing our asset account. So if we go back to the liability account here, if we pay off loans, that's going to reduce our cash position. Pay a dividend or buy back stock, we're going to reduce the equity account or reduce cash. The purchase equipment, we're using cash to do that. So that's how these various activities will impact the firm's cash flows or cash position. The other thing to note, the accounting is done on an accrual basis. So the transactions recognized when the transaction takes place, the cash flows may not occur for some time, but they're recognized on the balance sheet and income statement and so forth. So that's an important distinction with regard. So they don't really present a true picture of a firm's situation. So we've the Unilate's sources and uses of cash for 2000 or December 31st, 2016 and 15. So cash and marketable securities. We see that cash and marketable securities went down. Accounts receivable went up, so we owe more. Inventory. That looks like that's backward. Let's go back. I'm going to go back to the balance sheet here. Yeah, they switched the inventory. This is inventory is 270, and if we go back here, these two numbers are switched. So this should be 270, and it should be 200. So hopefully we'd gross plant and equipment 680 million versus 600. But okay, so this is reflected correctly here. So this the increase in accounts receivable. So we're owed more money. We have more tied up in inventory. We have more tied up in gross plant and equipment. So those are all uses of cash. Accounts payable. Our accounts payable went up 15 million, so that's a source of cash. Accruals are a little greater. That's a source of cash. Notes payable or increased. That's a source of cash. Long-term bonds are increased by 45 million. So common stock didn't change. So you can see how that infected the firm's cash position. So this is the statement of cash flows that we've got. Here we got net income. We're going to add back depreciation because it's not a true cash flow. We increase in accounts payable, increase in accruals, the increase in accounts receivable, the increase in inventory. So our net cash flows from operations is 34 million. We acquired fixed assets of 80 million. We increased our notes payable, our bonds payable, and then we paid out a dividend. So the net impact was a decrease of 25 million in cash, which we saw earlier. So the beginning cash went from 40 million in 2015 to 15 million at the end of 2016. So